It's a pleasure, Jonathan. Thanks a lot for the invitation. It's great to be here. So this paper is joined with Luis Giacome from Georgetown, Samuel Piagnacura from the IMF, and Nico. Nico, do you want to say the disclaimer for the IMF?
The views expressed are those of the authors and not necessarily implies anything about the IMF executive board, staff, or management, just to make that clear.
Great, thank you very much. So this paper, the motivation for this paper is that typically when we introduce monetary policy in models, typically variations of the NK model, we don't take into account, or we assume that they are history independent. But many countries that inflation targeting, both on developed countries, emerging countries, have had a history of high inflation before the implementation of inflation targeting. And there is a huge literature in behavioral economics saying that history matters for expectations. So we thought that it was important to investigate this. Our analysis is both theoretical, just as to have some intuition, but also mostly empirical, and see how that history affects monetary policy. The analysis is going to be concentrated on countries that do follow inflation targeting. This is a relevant set of countries. There are by now more than 40 countries that follow inflation targeting. The number of countries following inflation targeting has increased over time. In the three categories of countries with respect to development, developing countries, emerging countries, developed countries. We have more countries in all those categories. Inflation targeting now is a mature form of implementing monetary policy with almost more than 35 years of life, starting with New Zealand in the late 80s. Israel is in this set. I think Israel joined in 1997 in the group of developed countries. So it's around, it's in this graph somewhere. So that's our set of interest in this study. So before I start plunging on in the presentation of the specific results, a preview of results on the theory part, which again is going to be a very simple model to motivate the empirical work. What we find is that for inflation targeting countries, a history of high inflation is costly. Is costly in terms of output loss. So being an inflation targeter, if you carry a history of having been a high inflation country, introduces costs or carries, entails costs in terms of output. And it also makes the policymaker more hawkish. Before I continue, feel free to jump in with whatever questions you have. Both Nico and I welcome questions. So on the empirical part of the paper, we have two main results. The first result is that if you are an inflation targeting country, your inflation coefficient, the inflation coefficient of your Taylor rule or of your policy function, is twice as large, so you are twice as responsive to changes in the inflation gap if you had a history of high inflation before you adopted inflation targeting. And the second result, which we call a credibility puzzle, is that that doesn't go away with time. So as time goes by and you consolidate yourself as an inflation targeting central bank, that characteristic of your policy making doesn't go away on average, on average in our sample of countries, in this sample of countries. Okay, I'm not gonna dwell too much on the literature because in the interest of time, but basically our paper has points of contact with three sets of papers. The first literature is a literature that here we are not doing justice to any of these three literatures here with this list of papers. All three are really big. But the first one is a literature that empirically documents what inflation targeting has done in terms of its ability to stabilize inflation, its ability to stabilize output. The second literature, which is a literature we draw on a lot, is a behavioral empirical literature that documents very clearly, and this is a very robust empirical finding, that history matters for expectations in a very large set of variables, environments, countries, etc. But in particular, what has been very well documented, which is relevant for our study, is that high inflation episodes linger for a very long time in people's minds, in people's expectations about future inflation in particular. So that's going to be something that we are going to base our analysis on a lot. And the third set of papers that are related to our work are papers that have to do with how credibility affects monetary policy, in particular, how hawkish the central bank is. Okay, so theory, as I told you before, our theory is going to be disarmingly simple and is going to be used to motivate our empirical work. So what we're going to do is we're going to use the simplest possible Keynesian model, a linearized model, and we are going to introduce into this model two things. First, we are going to assume that the central bank is an inflation targeter, and second, we're going to introduce what is called experience learning. So the model is going to have the three well-known equations of the Keynesian model. The first equation is an Euler equation, or what is called the expectations augmented IS curve, which basically says that output growth, here output is YT, YT is the output gap. Everything here, as you know, is expressed in terms of gaps. This is the linearized version of the NK model. So basically the Euler equation says that the expected growth is a negative function of the real interest rate, of the expected real interest rate. IT is the nominal interest rate, the gap in the nominal interest rate with respect to its resting point, and ET of pi t plus 1 is expected inflation. Pi t is the inflation gap, that is to say, the difference between inflation and the inflation target. So that's the familiar IS curve. And the Phillips curve says that the inflation gap loads on two things. It loads on expected inflation with the factor beta, and it loads on the output gap with factor kappa. Remember that in the, and this is going to be very important for this simple model that we are going to characterize here, the equilibrium we are going to characterize here, and the different assumptions about expectations. Remember that in the new Keynesian model, expected inflation is a sufficient statistic for people's expectations about the present discounted value of future deviations of marginal cost from steady state, right? So that ET of pi t plus 1 is basically summarizing what people think are going to be future deviations of marginal costs from steady state, the present discounted value of them. And the way people discount the future is with the subjective discount factor beta. And kappa is a summary, among other things, of how sticky prices are. So the smaller is kappa, the more sticky prices are. So that summarizes the new Keynesian model. The last equation is a very stark way of inflation targeting. We are going to assume that this is a strict inflation targeting central bank. In our empirical work, we have a much more flexible inflation targeting representation given by a Taylor rule. But here, to make things simple, we assume that this central bank is a strict inflation targeter. So this central bank is going to insist in having inflation at 0 at all times. Okay, so the solution, the rational expectations, we're all familiar with it. If the central bank is a strict inflation targeter, that is to say, if pi t is equal to 0, then at all times, so the central bank commits to that at all times, then obviously under rational expectations, the expected value in period t of inflation tomorrow is also going to be 0. If you plug those two things in the Phillips curve, which I repeat here, you right away get that the output gap is going to be equal to 0. Okay, so in this model, if there are no shocks, there are no costs at all of ensuring that inflation is at target at all times. If you then go with your inflation equal to 0 and the output gap equal to 0 to the Euler equation, you right away can solve for the nominal interest rate, and you get that the gap between the nominal interest rate and its steady state value is equal to 0. So the government doesn't have to do anything to achieve what is called this divine coincidence, which is output at its intended level, inflation at its intended level, that is achieved without the government having to be particularly hawkish or dovish. Just a neutral monetary stance suffices. Okay, so that is the starting point. What we are going to do is we are going to introduce what is called experience learning. And we are going to do it in a reduced form. We are going to assume that people's expectation that this inflation targeting country had high inflation in the past. And this high inflation is denoted by high, by H. And that happened in the past. And the problem is that people learn from experience. So their expectations about inflation are marked by this high inflation, and they go away slowly at the rate lambda. This is a reduced form of a result, as I mentioned before, that is very well documented. It's documented in emerging countries, it's documented in developed countries. For example, the hyperinflations in Germany, Hungary, and Poland. So right there you have 3 countries, 1 developed, 2 developing or emerging, and a very high inflation an inflation rate that happened a long, long time ago. Well, there are papers showing that that inflation experience still lingers in people's minds. So this is a good summary of what this experience learning hypothesis says. It's a reduced form, but it's very, I think, very loyal to that that data. So expected inflation depends on the magnitude of the inflation experience by high, and also decays slowly at the rate lambda, okay, over time. Okay, what happens if we plug this into the new Keynesian model? Okay, so we remember that this is an inflation targeter central bank. So the central bank is still committed to having actual inflation, the current inflation rate, equal to 0 in spite of people's expectations. So let me silence my phone. Okay, so if you plug this into the Phillips curve, so we know that inflation today is 0. We know what the expected inflation is, so you can plug that into the Phillips curve, and you right away get the inflation gap. And what you see here in the box equation that I have in the middle of the screen is that for this inflation targeter country, central bank, ensuring that inflation rate is all the time at the target when people experience this way of learning is costly. That is to say, the inflation gap is going to be, output is going to be below its intended level throughout, as long as this inflation experience is in people's minds. What does that mean? That means that being an inflation targeter is costly if the country experienced high inflation in the past before adopting the inflation targeting paradigm. So how costly? Well, it depends on the size of the size of the inflation experience. The larger was that experience, the larger is the cost of inflation targeting. It depends on both how much people discount the future, but also not only on how much people discount the past, which is lambda, but also how much people discount the future. So it depends both on beta and on lambda. It depends on beta because remember that expected inflation is, in the new Keynesian model, as I told you before, is sufficient statistic for people expectation of marginal cost in the future, and they discount that future at the rate beta. So the more slowly they discount the future, the larger is going to be the role that those high marginal costs are going to play and how they are going to be passed on into inflation. So that is why it depends not only on how people remember the past, but also how people discount the future. Obviously, it also depends on how slowly people forget the past, right? So the larger is lambda, the more slowly people forget the past, the more persistent and larger is going to be this sacrifice that an inflation target has to make. It also depends on how sticky prices are, right? Obviously, because what is going on here is that people have this expectation that marginal costs are going to be high in the future, and the central bank is really committed to keeping inflation at target. So the only option the central bank has to do is to counteract those expectations with a very slack, a very cold economy. So the government, the central bank has no choice but to make the economy slack. Okay, so that is the first result. Being an inflation targeter, if you had an inflationary history, is costly. It's costly in terms of output loss. What does that entail for the monetary stance? Okay, so now we have a solution for output. We have a solution, or we know that inflation is going to be at zero because if the inflation, the central bank is an inflation targeter, and we know what the expected inflation is. That is given to us by this experience learning. So we can plug all of that now into the Euler equation, and we get this expression in the box, which is, you can also almost derive it mentally. What the Euler equation tells us, if you look at the Euler equation that I repeated there, is that if you're an inflation target, the interest rate loads 1-for-1 with expected inflation. So that is why you have a one right here, right? That is why you have a 1 in this equation. That is the loading of expected inflation onto the interest rate. But the Euler equation also tells you that the interest rate has to, is the sum of the real interest rate and expected inflation. And the real interest rate in this model is dictated by the path of the output gap. And remember that an inflation history makes output converge from below to the steady state. That means that the real interest rate converges from above. And the central bank has to respond to that high interest rate by having a higher nominal interest rate. So that is the second term in this equation. The first term is the loading of expected inflation onto the interest rate. The second term is the loading of the real interest rate on the interest rate. And what you see is that the central bank has to be more hawkish than under rational expectations. So maintaining inflation targeting, if you had a history of inflation, makes you more hawkish. How much hawkish? Well, more hawkish, the larger was the inflationary experience. The larger is pi high. More hawkish, the more sticky prices are, the more slowly people discount the future. And then also it has to do with how people discount the past. On the one hand, this lambda, which is how slowly people forget about the past, makes the central bank less hawkish, but at the same time, it makes it more persistently hawkish, more hawkish and more persistently hawkish. So there are two effects of lambda here. The effect of lambda here has to do with the fact that if lambda is very big, the output gap moves very slowly. So output is very smooth. And if the real interest rate is very smooth, the central bank doesn't have to change the nominal interest rate that much. So that is this smoothing effect here. But at the same time, if people forget about the past very slowly, the output loss is very large, and that gets factored into the interest rate. So bottom line, if the central bank is an inflation targeting central bank, and it had an inflation experience, a high inflation experience before adopting inflation targeting, two things happened. First, it is costly in terms of output to maintain inflation targeting. Second, in order to maintain inflation targeting, you have to be more hawkish. The central bank has to have a more hawkish stance. Okay, so this is the very simple theory that informs our econometric work. And I'm gonna now pass it to Nico to discuss with you the empirical part of the paper. Any questions about the theory before we move on?
Yes, I have one, but for the others, please feel free to ask a question. Yes, so we have Yossi Yachin that want to ask a question. Please, Yossi, I will ask mine after.
Okay, thank you. I'm just wondering about the use, how appropriate is it to use this, well, the approximated model around which basically, when we approximate around steady state, we're talking about business cycles, and while the issue at hand is more long term. We're talking about legacy effects from high inflation a century ago. So what I'm a bit puzzled, it also shows up in this kappa. The kappa parameter hides the price stickiness. So if we're talking about more long term, and not about the business cycle, the price stickiness is relevant for business cycles, not so much for if we're talking about legacy effects for a long time. So this makes me wonder about how appropriate this approach is to analyzing long-term issues. And another related issue, well, it's a bit technical, but so usually we approximate around steady state because we're saying, well, okay, sometimes there's boom, sometimes there's bust, we fluctuate around it. But here, the long-term equilibrium is actually moving and approaching the steady state, which, well, the zero inflation equilibrium, the economy converges to it, but it takes a long time for the economy to converge to it, while the approximation is around that point. So I'm just a bit puzzled. How do you see this mapping between this approach, which is more appropriate for business cycles rather than to long term? Is it an issue? How do you think about it?
Okay, so two things. One, technical. So what I did here is a shortcut. I first presented the linearized model, and then I stack the expectations formation assumption. I can also do it the other way around. I can start with a nonlinear model, stick that expectation formation assumption, and linearize. The result is the same. So I didn't want to go that route because the route I took here is faster. Your question is very good because it is important to clarify that, yes, this is a problem of legacy of memory, but this is a short-run problem. That is to say, this is something that sticks in people's minds that is affecting the everyday working of the model. So this is not a long-run analysis. This is a stabilization problem that the central bank is facing in the short run. The problem is that expectations have very long memory. Okay, so that is not a problem. You raise a third in your question. You raise a third question, sub question, which is the question of what if these things are big, and that is important. If these shocks are very big, then you fall into the issue of how accurate is a first order approximation, right? You could do a higher order approximation and have more feeling there, or capture better the nonlinearities that could be going on. So that third part is well taken in the sense that, but we decided to keep it simple here, just to be able to show it in a couple of slides and to motivate the empirical part.
Thank you.
No problem.
Thank you very much, Yossi, for your question. We have another question from Amit Friedman.
Hi, thank you. My question is about the treatment of inflation targeting. I think that usually if you have a legacy of high inflation, you wouldn't like to treat it at once and to immediately go back to a new low target. You rather do it gradually. So in your model, it's costly because you're giving a in a sense, a cold turkey treatment to the economy. But I think that in real life, if this is about hyperinflation, you don't use the term, you're just using high inflation. But if you have in mind hyperinflation, I think that it's indeed, it would be very costly, but I guess maybe this is the reason it doesn't happen usually.
I agree with you 100% in the sense that this is a very simple problem that we solve here for motivation. But one of the things that this research, one of the questions that this research opened to us is what is optimal monetary policy under experienced learning? And I think that goes to your question, because my hunch is that the solution is going to be very much in line with what you're hinting at, which is that the cold turkey. My hunch is that this solution is not going to be optimal. Okay, we just want to point out here is that if you're an inflation targeter, you're going to face costs. The costs are going to be exactly like this. My hunch is that in an optimal monetary policy setting, they're not going to be like this, because people are going to incorporate what you were just saying. I remember in 1985, I was a student in Córdoba, Argentina, and the Econometric Society meeting, the Latin American chapter took place in Córdoba, and one of the keynotes was Michael Bruno. And his whole speech was about expectation management. And I think he was talking about that. To the extent that you can affect those memories at all, the empirical data we have is that there's very little one can do about that. The central bank will try to do it. But on top of that, I don't think the central bank is going to start with, say, an inflation target of 2% right after the hyperinflation. I think that the optimal solution is going to be a time-dependent path for the inflation target, maybe a declining one. But a lot of things about the credibility of the inflation targeting regime itself will play a role there, because if you start with a very lax inflation targeting, you're trading commitment and credibility and all those margins at the same time. So I think that opens a very, very interesting set of questions that we don't address in this paper. It's for a different paper.
Okay, thank you, Amit, for your question. We have a question from Juan Camilo Laborde Vera.
May I add something to what Martin said, responding to that comment? I think it's relevant, is that if you look historically at inflation targeting, I mean, inflation targeting is not used to stabilize high inflation. Usually you do either monetary aggregates, you do exchange rate based stabilization. You go to inflation targeting once you have inflation historically around 10% or low. I think in our sample, only 2 countries were like 11 or 12% when they implemented that. So this is not a tool to stabilize high inflation. The analysis is once you did control that, but you have a history, what happens? Let me stop here.
Thank you, Nico, for this clarification. Juan Camilo Laborde Vera, do you have a question?
Hello, yeah. Can you hear me?
Hi.
Yes.
Yes, perfectly.
Professor, thanks very much for your presentation. It's very interesting. It's a very elegant way of modeling the issue at hand. But I'm wondering what would happen in a dynamic model where P, H, and lambda are dynamic and depend on the response and the hawkish response of the central bank. So, for instance, I may think of a model where people seeing that the central bank is acting accordingly to a very hawkish stance, like its policy preferences may induce people to stop having such a way of forming expectations. I'm wondering what do you think about that? Maybe people change their expectations when the central bank tries to change the way they form expectations.
Yes, no, I think that is a very relevant question. My reading of the empirical literature is that uh, these expectations are very stubborn and they change mostly with um, demographics. So I don't think that um, the central bank can do much about. I mean, that is my reading, right? I think more research is needed in this because the literature on experience learning, the empirical literature, at least my reading, is that it has not been conducted until this point with an eye on what is optimal monetary policy and on whether central banks can do something about it. Um, but you're totally right. All we are getting here is how the inflation target in central bank adapts to that situation. But this model doesn't say anything about what the central bank can do to affect expectations. So here, the path of expectations is exogenously given, and the central bank is doing what it has to do to keep inflation at zero. But again, I think to address your question, we need first to look at the empirically, at empirically at this problem, and from a different angle, from an angle whether central banks have been able to shape expectations in countries that have experienced high inflation in the past, right? I'm talking about those countries. And I don't think the literature addresses that. The literature is only saying what happened with expectations for people who experienced inflation in the past and what central banks have done. But it doesn't say anything about whether central banks have any margin to affect those expectations. Once we learn more about that, I think it's not difficult to incorporate it into a model and say, okay, so then if I can influence expectations of those people who experienced high inflation in the past, how should I change accordingly my monetary policy?
I'd like to give the floor to Nico to expose the
Yes.
empirical part.
So let's try to move on to the data. The two bottom lines of the theoretical framework that Martin presented are: we see, or we can think of, the existence of this path dependence that models, or most models, theoretical models of inflation targeting have not paid attention to. So there's path dependence, and also the issue of credibility. So we try to address that, to study that, and essentially what we're finding is that they matter. That inflation, past inflation, is important when looking at the response of inflation targeting central banks, and there's this credibility puzzle that we labeled in that. Seems to be that the coefficient in the Taylor rule is not only stronger for those countries that experience high inflation, but it's time invariant. So even though we thought that as you mature in your central bank and you increase your credibility, that coefficient should be smaller. You would need a smaller reaction in interest rates to deviations of inflation or expectations of inflation from target. You would need a smaller adjustment in interest rate. Actually, that's not there yet. I'll come back to that. So what do? We follow standard literature. We do panel of Taylor rules that we estimate. We have 30 plus countries. And one thing, when Martin explained the literature, one thing that was there was that the received wisdom has mostly compared the outcomes, be that inflation, output, I mean, you name it, in comparing inflation targeting central banks with non-inflation targeting central banks. What we do here is different. We focus only inflation targeting, and we're going to exploit an heterogeneity among what has been usually labeled as a homogeneous group of inflation targeting that we think it's important, and we get interesting results. So the baseline specification is, I mean, we have for country C in period T, we have the monetary policy rule interest rate on the left. We have country fixed effects. As is usual, this is a very persistent process, so we have the lag interest rate. The two main concepts, I mean, there that we want to test is the inflation gap, and I'll define this in a second, and the output gap. And given that we have many emerging markets and even some developing countries, I mean, we also take into account the nominal effective exchange rate. And also to control for global financial conditions, we have the lagged US interest rate. One thing that matters is which is the inflation gap. Martin raised this point in his part of the presentation, is that shall we look at observed, that be that core inflation, headline inflation, or expected inflation gaps? So if you go from a purely theoretically received wisdom, and we can think of the literature by Svensson in the late 90s, you should only care about expected inflation deviations from target. Conceptually, the idea was that if after, say, you have a monetary policy decision T, you make your decision conditional on all the information as of T. If T plus 1, there is some shock to the economy that results in inflation deviating from target, to the extent that that shock does not de-anchor inflation expectations, then you should not change your monetary policy. So, but the first step then, if you want the T-1 analysis that we need to do to change our baseline specification, is which is the inflation gap that we're going to care the most for. The pure theoretically, which is based on expected inflation, or if you think, and as many of you are central bankers, you perfectly know that when there are second round effects, maybe you may care about those two to the extent that those second round effects may eventually transfer into expected inflation. So that's what we do first. And then we do two more things. Once we establish that, and the preference would be, I'm anticipating it's expected inflation. We, number one, look at what is the role of credibility building, in the sense of, presumably, as central banks keep on developing, keep on having more sophisticated models, learn from themselves, develop their communication strategies, so on and so forth, you build credibility over time. So the longer you've been a central banker with an inflation target framework, you should be more credible. Presumably, you'd need a smaller effort to tame any deviation of inflation from target. So the coefficient in the Taylor rule should be smaller. What we found, as I said, is that actually that's not the case. And then we exploit this variation among central banks with inflation targeting more extensively, in that we also look at what's the effect of, number one, the specific role of having had high inflation, and I'll define this clearly in a second, in the past, on the one hand, and that's one of the main contributions we think of the paper. But also we exploit other state variables, such as financial development, trade or capital account openness, the independence of the central bank, because they matter for inflation targeting, right? If you have a deeper financial market, the transmission of monetary policy improves, and therefore also you would expect a smaller effort, a smaller coefficient in your reaction function in order to tame inflation deviations from target. more integrated financial markets also. I mean, they may increase exchange rate volatility, but they also usually come attached with more sophisticated derivatives, and so that would also well be a contributor to the reaction function of the central bank, how independent the central bank is, etc. So, what is the data that we use? For central bank data, we have policy rates we collected from the BIS, also from the funds RER. As of macro data, from the IMF's International Financial Statistics, we have inflation, we have the nominal effective exchange rates, we have quarterly GDP, which when we don't have it from the authorities, I mean, that's seasonally adjusted, but when it's not provided by authorities, we use Haber to adjust. We have expectations data that comes from consensus forecasts, consensus economics, which are professional forecasters, which we also adjust given that these are usually only end of year and we have quarterly data, but some colleagues at the fund have developed a way to try to approximate this to be 12-month ahead inflation expectations. And then what are high pass inflation? This is one of the key variables. The way we do it, our data set starts in 1960, if data is, some countries there is, sometimes there's not. And we compute, I mean, from whatever is the first observation of data from the World Bank data to 10 years prior to the implementation in each country of the inflation targeting, we compute the average inflation. Then we compare that to the distribution of all the country year inflation rates, and whatever is in the top 25th percentile, that's a dummy variable that would take the value of 1, indicating that country had passed high inflation. Regarding initial conditions, we take central bank independence from Romelli, financial development from Svidenska, 2016, capital account openness, we use the jure measure of Chinanito, but we adjust in some of the regressions for the degree of foreign exchange intervention, which is more a better proxy, if you want, for de facto integration with financial markets. And we have trade openness and historical inflation from the World Bank. So let me start with the results. Number one is, which is the right measure? So in all these columns, you'll see, different combinations of fixed effects, but there are two key messages that I would like you to take. Number one is, let's just compare the columns 1 through 3. What we see is that when looking at expected inflation, when compared to headline or core, it's about 2 times as large. We can think of the importance of anchoring inflation expectations, trying to this fear of high inflation. You care a lot about anchoring inflation expectations, and that in trying to go back to the theoretical presentation by Martín is you don't want your inflation expectations to really deviate, and then you're going to do as much as possible. Of course, to the extent that there could be second round effects, maybe you could start also reacting to observed headline or core inflation. That's one thing. But if we move to column 9 all the way to the right, where we have all the fixed effects that we could, essentially it's really expected inflation that we should care for, and that will be our baseline. That will be all the regressions that come after that will be based on this. Two things to mention is, number one, you may recall from the starting point of Taylor rules that usually you should care, the coefficient or the elasticity in the inflation gap is larger than 1. Given the way this is computed with the lagged interest rate, we have to adjust for that, but the implied coefficient is there here. You cannot see it. Yeah, here, and especially for our preferred specification is larger than 1. Just to mention on passing, but we see that the policy rate, it is an actually very persistent process with high correlation. There is some let me skip that. We also see an important role for I mean, U.S. interest rates. So the global financial cycle is present. I mean, there seems to be that it measures for policy interest rates globally. Another thing to mention is that usually the output gap is much smaller. The coefficient in the output gap is much smaller than whatever coefficient you see on the inflation gap. So you care more about the inflation gap than the output gap. That's one thing. So we're going to stick to this. The first part, how much do we care about the credibility and this credibility puzzle? So what we do is we add essentially the number of years that the central bank has been an inflation target. And what we see here, if you look at blue in the first column, is that the sign is the expected one. So that the longer you've been an IT central bank, apparently you've been building credibility, and that helps you reduce the amount of interest rate adjustment to any policy inflation deviation from target. But it's worth mentioning, number one, is the coefficient is way tinier than the inflation gap. Number two is not statistically significant. That's what the credibility puzzle, that even though you build your credibility and it seems to be pointing in the right direction, there seems not to be an effect. Of course, you can say, well, maybe your data set is too short, right? We have at most 35 years of inflation targeting experience, which in any case is good, because maybe we can rewrite this paper in 10 years and see whether these effects become significant or not. So we have that on the one hand. On the other hand, anecdotally, and Martin mentioned this also, is that if we think of Germany and other countries in Europe, 100 years ago, they experienced hyperinflation, and the central banks are still way hawkish. So maybe this will be there. But in any case, we will have another paper to write in about 10 years once we have more data. Two refinements to this is that maybe if we focus on column 2, is that you can think, is it really the inflation gap or the distance? I mean, how much you deviate from the target that matters. So to try to assess whether that was the case, we computed inflation gap variance, rolling eight quarters rolling regressions of the inflation gap variance, and we control for that. That's what you see in column 2. The sign again is the expected one. So the more you deviate, the stronger the reaction. And again, the coefficient is really small and not statistically significant. Another refinement is there's this data set this by Benz and co-authors about the sensibility of that central bankers have. Essentially, the more credibility you have, the less you should react. We see again in column 3 that the sign is still appropriate, but again, the size of the coefficient is small, and it's not statistically significant. Then we go back to history, and what we do is we look at the interaction of inflation gap and whether the countries have a high inflation in the past. And what you see, regardless of what combination of fixed effects you put, is that essentially the inflation gap, which is ballpark around 0.2, essentially is double to around 0.5, 0.4, 0.5. So the message here is the central banks that did experience high inflation in the past seems to be systematically more hawkish regardless. And I mean, I'm not showing them, but all the controls are there in all the regressions. One final thing before some robustness checks is we also try to exploit better all the heterogeneity among inflation targeting central banks. And you can see that if you look at whether they are more financially developed, there seems to be that on the margin, I mean, all else equal, countries with more financially developed financial systems tend to be able to deliver, to react in the reaction function in the Taylor rule with smaller adjustments in interest rate. When thinking about trade openness, apparently there's no effect. when thinking about central bank independence, the sign is the correct one. Only in one of the specifications, in number 4, do we find that more independent central banks seem to be able to adjust interest rate less if there there is more independence. And this is the specification when we adjust the current account openness by your actual intervention in foreign exchange markets. And likewise, I mean, the role of capital account openness itself, it's also only when properly measured, I mean, or more, no, I won't say properly measured, but when the de jure measure is adjusted for the intervention, do we see that those countries that are more financially integrated are typically able, on average at least, to react with smaller changes in interest rates. I think I'm running out of time, right? How much do I have?
Yeah, you have 5 minutes. Yeah, you can.
5 minutes. So let me quickly
5, 10 minutes. That's fine.
Oh, okay. Some of the robustness checks. Number one is maybe COVID was different, right? So what we did is we re-estimated the model pre-2020, and the results essentially do not change. Could be outliers, so we excluded Russia and Turkey. These are which are the ones we have with higher inflation rates in our samples. Results also do not change, as you can see here. Could also be, I mean, we can think of whether it matters which is the direction of the inflation gap. When we check whether there is a difference in case there is a positive inflation gap as opposed to a negative, I mean, the results essentially do not change either. Also, and especially for commodity, for net commodity exporters, what is the role of changes in commodity terms of trade? We control for that, and that's significant, which makes sense, right? You react more if you're more exposed to commodity prices, because that could have some effect on exchange rate and thus on inflation through the exchange rate pass through, and that will also hinge on the central bank's credibility. But despite controlling for that, the inflation gap effect is still there. Could also be thought of, well, maybe the learning process is progressive, so maybe we should look at the squared inflation gap. As you learn, I mean, there's some convexity there, but results again are not changing. We also added region-specific time-varying shocks. Results also hold. We also have the inflation gap in levels, but we have some countries with very high inflation, so we have to take this with a grain of salt, but still the result seems to be there. We also added a measure of persistence of inflation. Wage indexation and the like could also affect the decision of central bank, but still those results seems to be there. We put inflation in levels. We have whether the state variables were at the time of the adoption or contemporaneous, but again, the results did not change. I see there's a question. I'm happy to take it because I'm done with the robustness.
Yes, Eliezer Borenstein.
Only if it's okay in time, because it's not really urgent.
Yeah, I'm almost done.
Okay, so I had actually 2 questions. One was about well, here it seems that the focus is on how the optimal interest rate reacts to changes in inflation according to the history of the country. But I would assume that also different, or I would say, the response of the economy, of the inflation itself to the change in the interest rates will depend also on the history of the country, because I mean, taxations and stuff like that. So is that also in the analysis, or is it in the background?
We have country fixed effect, if that takes.
So that would, okay.
So that's time invariant for that's country specific. Let me try to wrap up a little bit about what we see. I mean, our results point to the importance of past high inflation. If you want, in Argentina, there's a saying that, which the translation is approximately something like, if those who ever get burned with milk, they would see a cow and start crying. So that's the main message of the paper, right? If you've experienced high inflation, you keep on being very reactive. Your inflation targeting, your coefficient is strong, and it seems to be, at least given our time sample for now, time invariant. This is consistent with essentially three explanations, some of which are already Martin mentioned. And on the one hand is, when looking at individual level, Malmendier and co-authors, I also did for the US, Samuel and I did some work for 40 plus countries. We show that individual level surveys show that those people that were more affected, either in levels, in persistent, you name it, by inflation, those people are more concerned about inflation. So that's part of this. Also, there's this work by Malmendier and co-authors showing that the Fed's FOMC, those voting members that were foreigners born in countries experiencing high inflation when they were young, they were like, probabilistically, I think it was like 0.3% more hawkish in their votings. So in a sense, is like, we think that this is probably interpreting that central banks, and in line with Rogoff, conservative central banks, they're internalizing that people really care about having experienced high inflation, and they try to react, and it's worth to pay the cost of whatever, say, recession, following the model presented by Martin, is in equilibrium, is worth paying for that to avoid any de-anchoring of inflation expectations. So let me just wrap up. So inflation targeting has been, and it continues to be, increased. And it started advanced economies, moved to emerging markets in the late 90s, developing countries in the mid 2000s. So it's become, I think, the central framework to conduct monetary policy. And as mentioned before, after you stabilize inflation, if you did experience it, this is just to do the fine tuning. And there's lots of theoretical models. What we think is lacking in those models, and the empirical evidence seems to point to that, is that you cannot assume the central bank is necessarily credible, and you have to be mindful of path dependence, because history matters, and it takes a lot of time to get rid of that inflationary measure. So let me stop here, but I'm happy to keep on taking questions as needed.
Excellent. Thank you very much, Martin and Nico, for your presentation. So now we will open the questions in Q&A. So Eliezer Bornstein, you have the second question.
Yeah, I just recalled it. It was related to one of the points you just mentioned. First of all, it was really interesting, so thank you very much. But in terms of the results are interesting in any interpretation, but I think the interpretation matters for the question whether banks are responding optimally or not, because under one interpretation, they should respond stronger if the country had experienced high inflation in history. In the other interpretation, they are just scared for no reason and are overreacting. So I was wondering if you could also, I mean, I know the paper is not about that exactly, but it would be interesting to test whether the results, the economic results in some countries were worse than the others, and maybe relate that to that issue. So just a thought.
That's a good point. I mean, like, I'm writing down, sorry. So as Martin said, we cannot say this is optimal. It's in equilibrium that we see that. We would need another type of analysis in order to show optimality. But I think we can try from the empirical point of view to see whether it makes a difference if of this set of inflation targeting countries, which were able to dominate easier or not inflation past inflation. That said, I mean, if you are already an inflation targeter, except just one case that was an inflation targeting for a very short period of time, usually that means that you were able to dominate inflation, because like I said, history shows that all countries that did became inflation targets, they first stabilized by exchange-based stabilization, whether pegs, bands, crawling pegs, I mean, you name it. They use monetary aggregates. We can discuss that. But so they first stabilize inflation. They progressively start to anchor inflation expectations. And when they reach the threshold of 10% or so, is that those mechanisms becomes too brute force, so they need more fine-tuning. And inflation targeting being forward-looking, despite our claim that, of course, we think they should be backward-looking, but the way it works, they are forward-looking. They help better to anchor inflation expectations, and thus permit a better. If you want a more efficient managing of monetary policy, once you have the. But yeah, that's as much as I can say, I think. Thanks.
Right. Thank you. Thank you very much.
Okay, thank you very much. So I will ask some of the some questions, but for the attendees, feel free to raise your hand if you want to ask any question about the paper or anything else. So again, thank you very much. It was a very, very interesting presentation, very interesting model and an empirical analysis. So I just have one question, at least for the moment, is related to the behavioral inattention literature and the potential links that the perception of history of high inflation history could have on, and the effect it could have on the model and the results. For instance, maybe you could add in the panel estimation a volatility index, whatever, or an uncertainty index. What could reflect, what you have in the behavioral inattention theory is that the more you are, you see inflation or macro variables that is volatile, and then the more you are putting attention. And it could increase or decrease the effect you have, because there is not only the level of past high inflation, there is also how you are attentive to it, and maybe it could be very interesting. Also, in a paper I published in the GIBO, we use several indicators that could be very interesting also to you, is the institutional quality, government effectiveness, and all these parameters that reflect how the people and the experts also are considering high inflation periods. Because if it was during a period that the institutional quality or the government effectiveness was low, then maybe there is less credibility and then less consideration. But I do think that you should add such control variables, and I think there is this for each country that you are analyzing. Yes, so this is for the empirical. So please reply, and then I will have a question on the theoretical part.
No, these are good points. I mean, we have the central bank independence index, which captures that. But I mean, point well taken. I mean, the only volatility measure that we have is the inflation gap volatility, and did not make any difference. But we can try others. As a hint, in the other paper that we did with Samuel on individual level surveys, we tried either past high inflation or past, I mean, and we also look at past volatile inflation, past persistent inflation, and all the results were essentially were not changing. So I think that making those adjustments, we also controlled for institutional quality in that paper. So I think these are good controls. I wouldn't expect the results to change, but I think we can try. We have to see how much of that is correlated with central bank independence, but maybe we can try it separately. But no, those are very good points. Thanks.
Yes. So before asking my theoretical question, I see that there is a question in the chat. So I will ask, I think it's a data question. So it's from Maria Siranova. So good afternoon. I apologize, but my microphone is not working. I was wondering, as this inflation experience is age dependent, it would be possible to incorporate the age dimension into the empirical part by looking at the characteristics of age pyramid in sample of countries, if not entire cohort distribution, at least, for instance, age dependence ratio. In many countries, there are still many economically active individuals who remember the high inflation periods. Hence, the subjective inflation experience might be potentially calculated at macro level. So
yes, those are very good points. I would reply two things. Again, going back to our individual level paper that we did with Samuel, we actually showed how in the service at the individual level, depending on what age you were when responding, how aware and how concerned you were about inflation, and those that were more concerned were not young people, which are usually, at least theoretically, indebted, and they were those with that they build assets. So in the 40s and before retirement. What we did try here is but it's a shortcut to that. We may be able to control by I think it would be interesting to control for the income the age distribution country by country. What we did an experiment is looking at separating high inflation in the 10 years before to 25 years as 25 and before. And my recollection is that most of the information came from the older periods, so mainly coming from older people, which presumably they experience higher inflation, but I had to go recheck those results. So, but those are good points. Maybe we want to control for the age distribution at each point in time. Why? Sounds good. Thanks.
Thank you very much. Thank you very much. So if we have any other questions from the attendees, please feel free to raise your hand. So I just have one last question, is about the model and the theoretical part, which is very, very interesting and intuitive. I think the model is very simple, but I'm just wondering that maybe it is a bit too simple in the sense that you could have interactions. Okay, so if in the model you focus about the history of high inflation, then why not focusing on the history of high output gap or a high interest rate? Because you have a model with these three variables. This is very standard new Keynesian model. I understand how you deviate from the adaptive learning is by adding this power. But again, how it interacts with other beliefs, because what you are doing is you are transitioning from a rational expectation model to an adaptative to high inflation period models. But what about the other high levels, about the other macroeconomic variables and how it interacts between them?
No, that's a good question, and I think just to give it some empirical background to your question, there are models that say there are empirical studies that say that people who were exposed to large recessions have different outlooks about the path of output, a more grim, more pessimistic outlook about output developments many years after being exposed to a large recession. For example, people who were exposed to the Great Depression. So, so your question has an empirical foundation that has been detected, and I think that could be introduced in the model, because remember that in the model expected output growth is important. It enters, for example, in the IS curve, and it enters in the IS curve because output growth is one of the determinants of the real interest rate, and the real interest rate factors in the Euler equation. So one could, in principle, have a symmetric approach to modeling this, right? And take from the empirical literature a stance of how experience learning affects, expectations about output. So I could have added a second equation there, capturing not only what the literature has about experience learning for inflation, but also what it says about experience learning for output, and stick both of them into the model and see how they both affect the cost of being an inflation targeter and the monetary stance. So that is doable even within the simple model we presented today. So that's a good point.
Got it. Thank you very much to both of you. So if we have no additional question from the attendees, okay. So thank you very much for being with us and presenting us this fantastic paper. I wish you a lot of success with it, and hope to see you again here.
It's a pleasure to be here, and thanks a lot for the invitation, Jonathan.
With great pleasure.
Same
Thank
here.
you,
Thanks
Martin.
for the
Thank you,
invitation.
Nico. Thank you, Nico.
See you.
Bye-bye.
Bye. Thank you very much.